Prices and buyer demand is setting up to go crazy again. All right, guys, buckle up. We've officially left behind a massive 3-year boom, and what's on the horizon? A wild twist that nobody saw coming. We're diving into what's changing in the market right this minute, and it's not just numbers. I've got 3 unbelievable stories that are gonna make the next decade one for the books. So let's get into it, and trust me, you'll wanna stick around for the wild twist of fate at the end. Before we dive into those jaw-dropping stories, it's crucial we start with the local market data because the data is our map, which is gonna guide us through the twists and turns of our housing market over the last couple decades. Understanding where we were and where we stand now is the only way we can really understand where we're heading next. So let's dig into the numbers and lay the groundwork for the surprises ahead. We're going to start off with the Fort Myers housing market data. At the top here, you can see the slider shows all the highlights really of the market, and that's what I'm going to be going over quickly. So for Fort Myers, $451,000 is the average sale price right now. That is down 2.6% from last month. 919 brand new properties came on. That's down also, down 1.5%. And then sold properties, that's actually down 6.95% to 383. The amount of days on market takes about a day quicker than normal. And then 95% is the average sale price compared to what it's actually listed as. Things are not selling at 100%, as you can imagine, with home prices decreasing right now and buyer demand at almost all-time lows. And then the average price per square foot is $254 per square foot for Fort Myers. Now, you guys can go in and take a look at this if you want to use my website, but it breaks down all the trends over the last year for all these numbers, so you can go through and see that. You can go through a map and see all the properties as well as what's on the market right now, and then also what's been closed. And if you're interested, you can also sign up and subscribe to this so you get either weekly, monthly, or even quarterly updates right to your inbox, right into your email. Moving on to the Cape Coral housing market. Average sale price in Cape Coral right now is $469,000. That's up 2.5%, 7%. New properties down 1.5%, down 879 properties. Sold properties is actually down 7.3%. That's a pretty good size drop. So you can tell buyer demand is way down. And because most of the buyers in Cape Coral area are probably financing and mortgages, those rates are really crushing demand in that market. Average days on market's actually decreasing a little bit too because there's so little inventory. And then the average sale price is selling at 97% of asking price, which is still pretty high. And then at the back end, you have $256 per square foot is the average price per square foot. Now for Naples, average sale price here, as you can see, is quite a bit different from the other two markets. $911,000 is the average sale price here. That's still down 3%. Then you have new properties, 1.29 thousand. So you can see there's a lot of inventory built up in Naples right now. Number of new properties is up 5% there. Solds is down almost 5% to 539. Still a lot of people hanging out of the market right now. Average days on market has decreased, so things are selling quicker. 96% of asking price, still pretty good if you're looking to sell. Just, realize when you go into it, it is going to be a little bit lower than you probably put your asking price for. And then $432 per square foot is the average sale price right now in Naples. So as you can see, Naples is kind of a whole different animal from Cape Coral and Fort Myers area. It's just a higher price point altogether. So what does this mean for you as a buyer or seller? Well, that's what we're going to talk about right now and take a look at. For those of you who are sellers, be aware that homes are taking about 2 months to sell in most cases right now. And that's mainly due to the demand being very low from the interest rates. Shock and awe. We're at 8% and we went up from 3% in just about a year. So the declining home prices are also showing that prices are trending down right now. And the best way to sell a home is to price a property ahead of the trend. So this might be a few $1,000s below the fair market value. And unfortunately, this is also what can end up leading to pricing wars where it can become a race to the bottom pretty quickly. So my recommendation is if you really need to sell quick, and that's if you really need to sell quick, is to get out ahead of the trend and be the first to sell. Don't play slap for slap with other sellers. Just bite the bullet right now and sell it sooner rather than later, because waiting is only going to decrease the gains you can walk away with later on. Now, for you buyers who are waiting on the fence, or just buyers in general who might be in the market still, despite this being pretty much the most expensive time in history to purchase or own a home, market conditions are actually pretty favorable for you. If you can comfortably afford a home, and I stress that more than anything, I'm not here to tell you need to buy a home right now and FOMO, you might miss out. We don't know what's going to happen. But if you can comfortably afford a home and you can project staying in that home, I would say for at least 7 years, the inventory has increased and prices have been decreasing. So, just this past week, mortgage rates actually came down to about 7.5% again, with the bond market actually showing that they might come down even further pretty soon. Now, that's not guaranteed, so don't rely on that as the gospel. But on the other hand, if you can wait a year or two, it might become more affordable temporarily. That's if the Fed cuts the rates. But we're going to go into that right now with our first story, and that comes to us from Bloomberg. So the bond market is predicting the Fed will cut rates in June now, not July. So if we look at the historical data to see how quickly they cut rates in the last two cycles, we see it's usually between 9 to 18 months, going all the way back to the 50s. Recently, it was just 17 months in 2007 and just 9 months in 2019. So notice also in this chart that the last two times they cut rates has been right around July. And according to this article, that may be when we see the next cutting cycle begin again. So what does that actually mean for you? Typically, mortgage rates follow the Fed funds rate because it makes lending money between banks cheaper, so they can afford to originate more loans. And that's how banks make money, basically on your interest. So lower rates is good for you if you're a buyer looking to get into buy, right? Well, when the Fed cuts rates, which you can see in purple here, that translates to lower mortgage rates for buyers. And then you combine that with declining inventory, seen here in red, plus lower home prices, which we've been seeing over the last few months, and the fact that 2/3 of Americans who are planning to buy a home are waiting for rates to drop. What do you think is going to happen next? Well, here's what happened over the last week. Mortgage rates experienced their biggest 1 week drop in over a year, causing the first increase in mortgage demand in over a month. So, unless inventory picks up quite a bit, a large wave of buyers are likely going to enter the market when the Fed cuts the rates. And even if levels of inventory actually improve some, it could potentially lead to another housing boom with increasing prices and bidding wars all over again. So, that's exactly what the Fed is trying to avoid. That could lead us back into inflation again. The Fed would need to raise rates again, and as soon as you know it, we're back into the 70s and 80s cycle, and the market needs a reset. And that actually leads us into the twist you guys have all been waiting for, the Great Reset, which is the slogan, "You will own nothing and you will be happy." A little creepy, right? Well, the real story lies in who's actually pulling the strings, and it's not who you think it is. See, after the 2008 housing crash, big corporations started buying up single-family homes, and that's no surprise. Everybody knows that already. But that's not the whole story. This investing article from September 2013, when the market crash finally bottomed out, actually tells you who it is without telling you who it is, if you know what I mean. So let's see if you can figure it out. Justin Berman, a former Goldman Sachs banker, said this is the biggest trade in the real estate space. They can't get their hands on enough homes. Well, private equity firm Blackstone, is that a surprising name to anybody? For example, has been busy buying up scores of single family homes at dirt cheap prices, fixing them up, and then turning around and renting them out. According to Blackstone, household formation and population growth in the US are solid, but new housing supply is 63% below historical average, creating a compelling opportunity to invest. Now, if you all remember what happened, we had a huge building surplus of homes. People were buying them, obviously, for investment opportunities, but they were doing it with, they really weren't qualified to own the homes. And then after the crash happened, you had all those builders. A lot of them went belly up. A lot of them just stopped building because they thought we had way too many homes and they needed to make up for their inventory. So as this article goes on to tell you, the truth is it takes a lot of money and time to really make a venture like this profitable. So rather than simply buying physical property and renting it out, now we can own a basket of appealing properties by investing in real estate investment trusts or REITs, which I've talked about in the past. So did you catch that? If you can read between the lines, the main culprit isn't the corporations. Surprisingly, big corporations only own about 1.6% of all rental properties. The other 98.4% is owned by mom and pop landlords and investors. And even if big corporations were buying up all the properties, guess who they work for? That's right, you and me. They work to make money and make a profit for their shareholders. And if you own stock in the major indices, have an IRA or a 401k, or your pension is in a hedge fund, more than likely you're one of those shareholders. You only invest in them because they earn a profit, or at the very least are supposed to earn a profit for you. So think about that for a minute. You give your money to them to invest in properties that will earn a profit, and they turn around and actively compete with you in the same market you're trying to buy in. Pretty crazy, right? So whether it's big corporations or mom and pop investors, it's us doing it to ourselves. It's the snake eating its own tail, and a cycle I'm not sure how we plan to get out of. But will this actually happen? Let me know your thoughts in the comments. Maybe we will become a renter nation, and maybe we will actually end up owning nothing and being happy. But while I'm still here, I'm going to do everything I can to own and help you own when that time is right for you. Now, if you want to learn more about what it's like living in Southwest Florida, like where should you live or how can you buy for less and sell for more, then subscribe to the channel and hit that notification bell. You'll thank me later. And if you're in the market to purchase a home right now, I recommend new construction just because it's one of the more affordable routes right now of purchasing. And they are offering some pretty amazing rate buy downs, closing costs, and other incentives right now. Some builders are actually even lowering prices, which is usually a last resort option. So there's definitely deals to be had. But before you start shopping, start with this next video going over everything you need to know about the home buying process and how to avoid the most common and costly mistakes. I truly appreciate you watching till the end, and I hope to see you in the next video. But until then, stay safe, stay positive, and more importantly, stay free.